This looks like a good setup. The market should go up. And then it turns into a straight loss trade. Everyone knows how it feels, but after this video you will avoid the mistakes that leads to this. What usually is done right when you enter a chart is to analyze the market from a straightforward perspective, simple and quick, just to see if this market respects the uptrend formations or the downtrend formations. Now, if we check the internal price action, we would see a formation of a higher high, but then formations of lower highs. So the internal trend looks to be reversing from an uptrend into a downtrend, but the external trend is still bullish, because traders see this move as just an upwards push that later gets followed with a downwards pullback. And now what they're expecting is a continuation towards a higher high. So if a beginner trader or someone that's not really so experienced sees what we mentioned, he is most likely going to look for somewhere to buy from and take the market higher, and probably he will do that from a mitigated support, just like this one. By mitigated support, we mean a support level that respected multiple times in a row. This type of support is low quality, because each time the price moves and rejects back from it, the chances of the support level breaking down increases. But this trader is not aware of this, and he buys the support, with placements of the stop loss that make sense, being below the support. However, this setup was very high risk and low quality since the beginning, so logical placements of the stop loss and take profit won't change much. And he gets stopped out of the position with a straight loss. Just so later the market regains bullish momentum, slowly and surely, which eventually moves into the take profit, but already too late since the trade has been already lost. Now the biggest problem most traders make here is that they don't even know, or if they know, they won't apply the simple characteristic of an uptrend. Since we already know from the first minute that this is an uptrend, on uptrends the market usually pulls back down into a demand level. So basically the next higher low that we see if we zoom out is usually ending right on a demand level, from where it rejects back to the upside, into breaking the past high. And basically the same thing happens over and over again, as long as the market is holding an uptrend. So if we apply this on the actual chart, we have this upwards push, then a pullback, and continuation to break the past high. This validates a demand on the last higher low, and we can see how it's exactly where the price has hit and rejected back to the upside. So the bounce doesn't happen from a low-quality support that has been hit multiple times, but usually it does happen from a higher quality demand level. But it's important that this zone has not filled many times in a row. So basically this demand is this one on the presentation chart. So that's how you actually avoid getting stopped out of trades that look good at the first sight. Because if we would have simply used the demand level instead of the low-quality support, this trade would close as a nearly perfect winning trade. Now let's see here. On the S&P, as usual, the first and most important step is analyzing the external price action.